Hey everybody, how's everybody doing today? Welcome to the Investors Q&A Ask Me Anything session. We're really excited to have these incredible, esteemed investors with us on stage, and I would like to take this opportunity to thank everybody here for coming. We're going to have basically a set of questions. This is your time to ask all of your burning questions. So I'll let each of you all introduce yourselves, and you guys can take it away.
Hi, everyone. My name is Tipatat Chennavasin, general partner and co-founder of the Venture Reality Fund. We invest in VR, AR, AI, and Metaverse, or virtual reality, augmented reality, synthetic reality. That's why we're Venture Reality. Some of our investments you might know of are Beat Saber, Rec Room, Job Simulator, but honestly, like probably the other ones that we don't hear that much about, but do such amazing work are in the healthcare space and training space. We've actually done quite a lot in enterprise and AI as well.
I'm Taylor Hurst from Convoy Ventures. We are an early stage gaming VC focused on infrastructure, technology, and platforms. So we traditionally do not invest in pure content. We are on our third fund now. We do invest globally and traditionally lead the majority of our rounds. We are a fund based in Denver, which is a little bit different than the majority of US-based VCs, but yeah, we are investing out of a $150 million fund today and have made about 6 investments out of the most recent fund.
Hi, I'm Cansu. At the moment, I'm investing as angel investor and also consulting the startups and the governmental projects that the technology ministers are doing in a few different governments. Before that, I had like 2 years of an experience in a boot camp and accelerator program that was a company doing in Turkey. And also 1.5 years, I managed the portfolio in a Luxembourg-based fund. And I'm the investor of the Shapes XR in that VC. At the moment, I'm looking for the opportunities that I could be in for the angel investor and also like consulting the companies, startups in the space.
Hey guys, my name is Petri, hailing from Finland. I'm the second partner in FOE Ventures. We are an early stage fund based in Helsinki, Finland. Launched about a year ago in February 2022. Investing at pre-seed and seed. We are 15 companies in. We do checks up to 500K and investing in VR, AR, spatial web, spatial computing, the metaverse, if you want to call it that word as well. We've been with my partner operating in this space for 7 or 8 years, so this is our first own fund. Mainly operating in Europe, but obviously super excited to be here and see what's happening in the space. Haven't been to AWE since 2019, so it's been good to be back here.
So the way we're going to run this is go ahead and raise your hand. We do want to make sure that we capture this because it is being recorded. So feel free to raise your hands. This is the time. This session is for you. So who's the first one? Okay. And please say your name.
Hi, my name is Max Sims. I'm the Chief Design Officer and co-founder of Gambit Labs. And what we need to do is we need to get some funding for the clinical trials before I think we talk to investors. Obviously, there's government programs we can do. Do you have any suggestions in terms of what we could do to get non-dilutive?
Sure. We've talked with lots, and we actually have companies in our portfolio definitely applying for those grants. And there are actually like services that can help you like write and they'll take a small fee, but it's oftentimes worth it. Then the other thing is partnering with universities and like teaching schools and working with them. And then the last, of course, is finding angels, especially, there are a lot of doctors that are like, hey, especially if their specialty is related to the things that you're looking at that are interested in finding solutions that you guys could provide. And so those would be the 3 I'd recommend.
Yeah, I don't think you have to separate VCs from this process as well. I think you just need to find the VCs that are willing to go early enough for that. Similar to him, we've also done early stage investments that required initial funding for everything from FDA approval to IP licensing, and it's more just finding the right investors. But then, yeah, I would second that the grant funding from universities or governments is going to be the probably easiest route to go, especially if you're looking for the non-dilutive funding. But I wouldn't write off all VCs, but then you are looking for dilutive funding in that stage.
Yeah, and very shortly, I would also suggest to go on the governmental programs, because there are a lot of fundings have been increased in the last recent years by the governments, giving either the incentives or extra funding to the projects like this. So I will suggest to go on that.
Yeah, for European companies, the EU is very actively supporting healthcare companies and health tech companies with grants. And yeah, from the previous accelerator I was running in the portfolio, there's a company in the healthcare sector, and they have probably around 300 doctors on their cap table. So doctors are actively angel investing in this space, which kind of makes sense for them if it's a surgical training platform, for example. You get a lot of surgeons who will be your active supporters and potential investors as well.
And there are also some health tech accelerator incubator programs too that are definitely worth looking at. I know, it was Cansu Cinar, USC, almost all of the big hospitals have.
Great question. Who's next? Nobody's got any questions. That's crazy. What?
Hi, everyone. My name is Victoria. I'm head of sales at Blackmagic startup. I have a bunch of questions.
Ask away.
Well, if you were to describe the ideal partnership between an investor and entrepreneur using the analogy, how would you describe it?
You're looking for an analogy for the relationship between the investor and entrepreneur. Mm-hmm. To be honest, I have always viewed as an investor as we are a quasi-employee for the founder. They are a BD pipeline for you. They're product testers. They are the people that are most excited about your company. So I mean, the way I view it is leverage them as much as possible, and you should be looking for their expertise, because the one thing that I think investors have that's a benefit is the amount of companies we do see in the space. And we have a lot of reflections, and I think we've all made investments that haven't worked out, and leveraging that expertise and knowledge is one of, I think, the biggest benefits of having investors on your cap table.
Thank you.
And I would say, working as a VC, my priority was always been being a strategic partnership. It's either you are leading the round or you are just a minority of the, you are having the minority of the investment or something. It doesn't matter. You just have to be the strategic partner, because we are supposed to see the bigger picture in the industry or in the space that you are doing your entrepreneurship in it. But you are going to see the details and you will see all the job. But on the other hand, I think the investor should really see the bigger picture and be a strategic partner. So my answer would be this.
Thank you so much.
Yeah, I think a lot of people view it as an advisor relationship, but I actually would push and say, think of it more as a consultant relationship. But instead of you paying them, they paid you. But use them, right? Don't be afraid to ask. Don't be afraid. I feel like sometimes there's this sense of, okay, they give us money. We just want to show our good face, and we just don't, we don't want to show any problems. No. Share warts and all, because they'll help you. They've been in the trenches. They've seen it. They can advise. As soon as you can, just show everything and really think of them as true partners and not just money bags.
Yeah, to that point, I agree. Full transparency is better than kind of waiting for the real problems to surface. Somebody on a podcast, I can't credit this, but I think it was pretty good analogy. You're not a football coach, but you're a boxing coach. So the meaning was that you don't kind of set up the strategy and then push the entrepreneur into the field for 45 minutes, and then at halftime, this is, by the way, soccer for non-US people. So 45 minutes in, you give a couple of tactical advices and push them back in. But instead, you have 12 rounds. After each round, you can kind of tweak the strategy or whatever product or mental support, which is a big part of being a VC as well.
Thank you so much. Thank you.
Anyone else? Sure.
Hello, everybody. Thank you for being here. My name is Jeffrey Chernick. I'm CEO of Morpheus. We're an enterprise collaboration tool for HR training, for future of work. I'm curious to hear how the landscape is changing for us right now. Like, our prospects were on fire a year ago, 6 months ago, and I would say in the last 3 months, I've just seen a squeeze of every budget, layoffs on almost every one of our prospects, and the landscape for enterprise is changing. And I know a lot of entrepreneurs, and we're all feeling the squeeze on fundraising. How are you navigating that as investors? Are you not investing as much? Are you looking for just like, I'm hearing like, I need revenue and I need month-over-month growth, and that's all I'm looking at right now because everything else is dead. That's the vibe right now. I'm in Venice, so the LA investment scene, that's kind of what I'm hearing, also what I'm experiencing. So just also, these aren't really very VR-specific investors I'm referring to. So I'm just curious, in this landscape, how are you navigating the current environment?
I mean, yeah, there's a general slowdown in tech, except for if you're generative AI. And so a lot of people are like, trying to say, oh, now we're generative AI, and now there's excitement. But fundamentally, though, I think there is this going back to the basics, and then trying to figure out, too, like in the shifting global economic situation, which are the companies that are the most relevant, make the most sense now, or like, again, a lot of these companies, your projections are based off of the fantastic times that we had, 2 years ago, a year ago, and things have definitely changed. And so trying to understand what's really interesting, though, is there are many companies that are really succeeding right now that are accelerating growth. And so figuring out, like, pivoting and finding out, okay, no, like, who's nimble enough to really figure out, okay, what's the opportunity and stuff. Hey, let's wait till the market recovers. It's the companies that are like, no. We are solving the solutions to thrive in this.
So on that note, if you're in the middle of a fundraise and you as an entrepreneur, you see the landscape shift and you're shifting with it, you might shift the product and now all of a sudden you're pre-revenue. So how do you, as investors, is that okay, or like do you?
It's totally okay, but there is a reset that kind of happens. Then you have, if there is a pivot, then you have to kind of discount, and then you have to feel, okay, is this the right pivot? And you're kind of reevaluating again. And we are seeing, again, down rounds. We're seeing, or like extended rounds. All those kinds of things. It's just the current thing that's happening right now. But at the same time, we are seeing companies that are successfully, accelerating in these times, and they are still raising up. So I don't know. It's definitely topsy-turvy, and there's no one real solution. But I will say, like, there's still a lot of money out there, and if you're hearing no and no and no, I think also it's like, okay, are you telling the right story for now?
And I think what's really important here is to, like, if you truly believe in the vision that that you're building towards, in this environment, you're going to have to be comfortable with probably taking an uncomfortable valuation and funding round. And I think that's probably one of the biggest concerns that we're having, even within our own portfolio, is, their runway. They raised a year and a half, 2 years ago, and now they have to raise now. And it's not the greatest environment for them to do that. And there's this belief usually that you have to continually raise these up rounds. You have to, whatever your last valuation was, you have to beat that again. And I just don't think that's possible in this stage, especially if you're a pre-revenue business. I think investors now seem to be coming down from that peak that they were at, where it didn't really matter what you were doing. We will fund it at the valuation you want. And the companies that ended up raising too high are the ones that I think are having the biggest issues now, trying to fundraise again. But I wouldn't be concerned about, if you have enterprise clients that are slowing down or cutting costs, or your connection at that enterprise is maybe gone now. I think it's just continuing to build towards that future, but looking at the funding environment as something that you're going to have to just kind of swallow your ego at this stage and be like, hey, a down round is okay or a flat round is okay, because I know in 2-3 years, like, we're still building towards a vision that is much bigger than this. And I think just being comfortable with that is really important. And I think, 'cause I think one of the bigger mistakes a lot of founders make is, especially just from my side, is, you come to us and the valuation's, 2, 3x higher than what we believe it is. And then you find out that the market's not going to pay that, and you try to come back to all these investors. But investors also have an ego, and the issue is like going back to them and saying, oh, well, now, it's a lower valuation. It's almost like a grudge in a sense of like, I'm not going to pay that either now. I wish you would have came to me with that in the beginning. And I think you should be comfortable with setting a floor that you like, that may be really low, and allowing investors to pay up if they believe in it, instead of hoping that they're going to pay up to the price that you're willing to give. And I think that's kind of how you have to think about this in this environment. It's just, we're helping our portfolio companies do this, and it's the exact same thing. So I think it is just getting comfortable with being uncomfortable with taking something that you probably weren't hoping was going to be the funding round that you need.
From my perspective, I'm gonna be saying that like the market itself will fit itself. Like in a couple of years, which would say like the Adam Smith model, maybe. I believe that it's gonna be the way that the market will fit itself. But like it depends on the vertical, of course. Like if the startup's gonna be much more affected or not. So I think that the consumer and the commercial part of the metaverse investments may be affected much more than the industrial part of the metaverse, because the industries are getting it like slowly, but they are giving much more steps, like the bigger steps on it when they are coming to the investment, and they are getting the back. I would say like they are getting the payback much bigger than the other industries. Therefore, I think it's going to be still continuing growing in the industrial metaverse investments, but on the commercial and the consumer part, of course, there will be some fluctuations. But again, as I said, like it's the Adam Smith model. The market will find its way in a couple of years maximum, because the world needs that one. Like there is money and there is demand. As much as there is demand on the industries, there is gonna be the supply. So investments will find their, I would say like their balance in a time.
Yeah, I think so. Overall, our strategy, like we identified a gap in the market in Europe. There's a lot more risk aversiveness in Europe versus US investors. So we saw that there's a gap in like pre-revenue investing in Europe, like pre-seed. So it's kind of, we haven't been touched by that problem that much, because like our strategy is to invest in pre-revenue. So whether it's a good market or it's a bad market, that's what we kind of set the fund up for. So we've been actively investing, like we've done 6 investments in the past 4 months. But overall, yes, it's a very tough environment. Like to Taylor's point, I think there is an opportunity, like if you to actually go to like really value-add investors that you might have not had on board on your first round, and approach them with probably a flat round, or kind of like get them on board and see, hey, like we have this traction, we've developed the product, we can offer you the same terms that we did like 6-12 months ago. And that's a lot what we've seen, kind of these extensions with really value-add investors, but you have to go back to the kind of previous rounds valuations.
And one thing I would add to this is, and I don't want to speak for everybody up here, but I don't see this funding environment changing in the next 18 to 24 months. And so it's either your company can stay alive for that time and you're fine without any growth funding, or you do just have to take what's on the table today and hope to get past that. Because I think that is a concern. Everyone thinks like, oh, we'll just wait 6 more months. My personal view is just it's not going to change in 6 months, and I could even see it getting worse. And so it's either like, yeah, you can make it 24 months with what you have and continue to build, or take that round that's on the table, and it may not be the best option. It may not be what you were hoping for 2 years ago, but if it's going to keep you alive and allow you to get through this environment, I think it's going to be worth it. And those are the companies that have come out on the other side and raise much larger rounds when their competitors weren't able to close any funding.
Yeah, I mean, obviously, just to add to that, we're still investing, but we are very carefully looking at how far does that money take them. So we can't, and because we're a relatively small fund, we need co-investors. So we can't invest just us if that will take them, the company, to 12 months, because it could be 12 months, it could be 24 months, it could be longer when you have to go out and raise again. So you can't do extension after extension and just keep drip feeding the company either.
Well, those of us who are startup founders know what scrappy means, right? Someone else. Yes.
You should look up the word sisu in Finnish.
Hi, I'm Greg. I'm a one-person company. Where do I even start with venture capital? Like, is there opportunity for a company like mine? Like,
Oh, I mean, absolutely. One of our portfolio companies is here today, and it's when we funded their pre-seed round, it was literally one person coming out of university. It's about putting together that coherent vision, and you really need to understand like what you're building towards. But I don't think there's any limitations to how many employees or founders you have to start a business. You just need to go find those investors that are willing to go really the pre-seed round, or even start to view like angel syndicates as an opportunity to get something off the ground. But yeah, I personally don't have any concerns ever with how many people are
is
part of the
there
business.
some kind of online marketplace for that, or?
Angel list for like your if you want to go for angel syndicates. There's also like we mentioned, the accelerator incubator process as well. I mean, I would look into all those. It is really nice to get those like that initial funding. Like as an individual founder, you're not looking for that $5 million round. Maybe even like 250 to 500,000 is enough, and you can usually put it together with industry experts and or just like general angels, or go through this accelerator program, which I think is immensely valuable. We can discuss the equity and all that at another time, but I really would not be concerned if just based off of like being a sole founder.
Great.
Some VCs have these programs where you can kind of just enroll, and they try to match make you with other like-minded people also. So that's worth looking into.
So I'm going to go contrarian here. And I just think solo founders, it's typically a bad idea. Or it can be the founder, but you have to have a team around you. You have to have a couple of people. If you can't convince people to work on this idea with you, how are you going to convince investors to invest in you? I feel like the only solo founders I've seen, it's like, okay, if they've had tremendous success in the past, or they're coming from Stanford or whatever. But like, if you're just, sorry, I have no idea who you are, so I'm just going to assume average Joe, random person. Get someone, especially if you've had someone that you've worked with in the past, that you've worked well together. And if you can't convince them that this idea is amazing, then I think you're going to have a hard time convincing other people.
And I definitely agree with Tipatat on that case, especially like if you're, if your company idea, whatever, like your project contains anything to do with the blockchain, please get reasonable advisors, at least if you are going to go solo. But I would always suggest to have someone nearby, because sometimes the mistakes or the wrong decisions that you may take can be stopped by your partner. It's just an additional eye, so that feels a bit safer from a VC point of view when we look at it. It's not impossible, but at least if you are going to go solo, have some strong advisors in it.
Anybody else? Oh, yes.
Hi, I'm Annabelle. I'm co-founder of Atopia. We're building a metaverse for arts and culture. And my question to you would be, as a pre-seed startup, could you maybe quickly draw your opinion on the perks and drawbacks of either going with angel investors or a pre-seed fund, and how that might change let's say the 18 to 24 next months for the startup?
On the angel investor side, I think compared to a pre-seed fund, because at your stage, you're probably going to get at most like 1 to 2 funds at that stage. But the value of the angels is if you can find a lot of industry experts, you can get a lot of people helping you out and thinking through different problems. And I know the most valuable like angel syndicates that I've seen put together are where you have somebody that comes in. It's like we've done BD at name your large tech company. We've done product management at another one. Maybe somebody was a C-level executive, and I think putting those people together are going to be probably more valuable at your stage, just due to the fact that you can, accumulate this like larger brain power through having the majority or having multiple people on your team at once. But then the pre-seed side obviously has the benefits of a probably very large network, obviously the experience of working with other pre-seed startups and seeing the failures and also what has worked. And I think that is also valuable. And I think there's also a lot of value in saying, yeah, we're going to bring in one pre-seed fund and maybe a few angels on the side and kind of combining that. I don't think it needs to be a one or the other. But there are different benefits for having that group of angels versus having a group or an individual pre-seed fund come in. It's just trying to figure out like what you need as a founder and what you need, like what your startup is looking for from a advice and expertise perspective.
I think the main question isn't necessarily whether it's an angel or a pre-seed VC. It's more like you have angels who will be actively helping you, and you have angels who will just put money in, and you have VCs who will be actively helping you, and you have VCs who will just put money in. So it's your task to kind of find the people who you think will be an asset for you along the way, along your journey, and not become like dead weight very soon after you've done the investment.
Also, like, it's really good, like, if you are going for the VC part, then there are some VCs that are also doing the boot camps or the accelerator programs, and then they become part of, like, your company in a very small amount of shares. But the good thing is, like, when you join those boot camps, or not the boot camps, but when you join their programs, incubators or accelerators, you become part of that network. It also helps you. It could be like any chance that, like, if you can't get the investment that you are looking for, or if you need anyone to merge with together, maybe that could be an option as well. But I definitely agree, like, in the way that, like, whoever you get as an investor, it's either angel or the VCs, get a strategic partner in the pre-seed round, because I think it's the most valuable one that they could add.
Someone else?
So looking at like how it is kind of proving difficult to get the full vision, full clarity of the devices, right? And converging on one sort of a standard. How do you see the devices themselves evolving over a period of time? And then second question is, based upon that, what is your kind of 10-year vision of Metaverse or this space, 5 to 10-year vision? Like where do you go see this going? Thank you.
Those are two huge questions.
Big questions.
Yeah. Oh, on the device side, I think it's pretty standard now. Like what we know is the state of the art for at least for a VR or even like a pass-through all-in-one headset, 6 degrees of freedom head tracking, 6 degrees of freedom hand tracking. Like the Quest has kind of proven that that's like the right model, and everyone's kind of built around that. And of course, very interested in seeing what Apple will announce, but it still seems similar-ish, right, in that same vein. On the AR side, I think it's still the Wild West. Like, we don't know what the device is going to look like for a optical AR that's going to have some kind of significant, like, millions of adoption, right? We haven't even seen that, right? So I think that still has yet to be decided. But I think the biggest problem is going to be input and figuring out like what is the right input, and especially for the need. And as we talk about, are these like enterprise use cases or consumer use cases? I think VR is very much figured out, and MR with the pass-through kind of figured out, but with AR we're still at ground zero pretty much, and no one's really kind of cracked that yet. And I would say, like, that's why we're a little bit behind in terms of like where we think the AR ecosystem can be. And then I'll just try to take a quick crack at that metaverse idea. But honestly, Roblox. Like, you look at what's happening in the Roblox ecosystem, where there's 50 million daily active players. It's the largest social network for that age group. But also, what's interesting too is that creator economy, where there's $1 billion. Oh no, sorry, was it? I forget how many now, but an insane amount of money being transacted in that ecosystem, but being paid out to kids, and that the user-generated content, the creators of that are actually making real money. Top Roblox studios are making hundreds of millions of dollars. And so knowing that kind of exists, but now bring it to scale. And I don't think it's necessarily about saying, hey, can we get grandma to be in the metaverse? Because in 10 years, the person that's in Roblox, well, more than 10 years, but in some time scale, that person in Metaverse in Roblox today will be a grandmother, right? So like, I think that's going to be the real reality of it. Instead of saying, hey, how do we make the Metaverse happen today? It's already coming. We just have to wait, but we can think about things to accelerate it.
Yeah, I think the biggest thing that's holding back, especially AR, is obviously just the hardware itself. It's not valuable enough today or good enough today for a mass adoption consumer event. It really isn't. I think Apple will kind of hopefully get us to a point of like seeing the future, but even that I do not believe is going to be a mass adopted product. It's kind of the product to showcase what it can be. That's why the price point is going to be so high. But I think everything from like light diffusion to optical technology is it's getting there, and it's just we're still waiting on that. I think you are right. Like VR is there. It's going to continue to get better. I still think it's going to be viewed more as like a game console than a true consumer device, and where you use it for everything. That's where AR is going to come into play. But yeah, in the next 10 years on the Metaverse side, I think what my biggest takeaway from the last like 3 to 4 years is that the Metaverse is going to come from something that I think wasn't initially planned for. I think Fortnite's a really great example of this. I think Roblox has proven that you can create this this environment and experience that has this persistence, interoperable type of vibe to it. But I think where the Metaverse is going to come through is like you have these widely adopted pieces of content, these widely adopted experiences that then expand through access to tooling and creators being players as well, and we'll kind of just see it happen naturally more than anything else. And I think a lot of people that are building different type of Metaverse experiences are actually going to find the most success building those experiences within other larger IPs or more widely adopted IPs, because the biggest issue with the Metaverse always is like we have great tools, we have this great infrastructure, but how do we get users to come here? And I think a lot of people are going to actually just find more success latching onto a larger user base and providing value through that ecosystem. And you'll have something similar to Roblox, where an individual game can be a $50 to $100 million piece of IP within a much larger ecosystem. And I think that's what we'll see happen over time. And I don't want to make any predictions on who I think wins that or who I think owns that, but that is kind of the view I have on it is that it will come from a more widely adopted platform that wasn't meant to be a metaverse, but then just kind of became one.
And also for like when you think of the Gen X and Generation Y, like in our generations, we just met the Internet of the things, like at least when we were in our teenage years. But the kids today, like they are born into the internet, and this is called like natural evolution of the digital. So they are becoming much more digital people. And what happens is, for example, 3/4 of the kids in America, aged between 9 to 12, are using Roblox. This is huge amount of number. And when those kids will have the purchasing power, when they are going to have the power to get the licenses of the applications, of the headsets, etc., they are going to be using it much more than that. So the tech companies really need to focus on the user experience, because it's the key to get the customers in it. So as much as they are going to increase their investments and the tech research and development on making much more user experience positive devices, it's going to be increased, because the coming generation is born into it. It's not like we are making a decision. It's like they are born with it, so they have to use those devices, which I think like in a couple of years we are going to see a huge booming, in my opinion.
Yeah, I mean, I was talking to a friend who had moved away from Finland with their kids, and I was just asking, like, how are the kids coping with leaving all their friends behind? And he was like, they don't have a problem with that. Their friends are with them all the time in their pocket. So that's like the future. If you want to predict the future, look at the kids and what they're doing natively, as you said, like in digitally. On the hardware side, I just have one thing that you should look at is it's going to come from Finland anyways. Like it's been with VR and MR and AR so far. So look at Finland.
Yay, Finland. Yes.
I would like to know about what do you think about the new jobs from the metaverse and all this new wave from all these new generations. And what about the boomers don't want to, all these new generations are getting up from them, and they just blocking up all these new advances of the new generations having and ideas because are different from them. So what about all these new jobs like metaverse builders of scanning things, or I don't know, what, like investors, how is you looking about to the future, about with the past? Because a lot of people too don't want to getting up all these things, you know. So what do you think about it?
I mean, this is going to sound really harsh, but I don't really think we have to worry too much about the boomers. And again, this goes back to my previous comment. It's not about trying to get the boomers into like VR headsets now, right? Like, there's a big enough audience already for a sustainable business without that. Like, if you want to get like tens of millions into headsets, that's already happening. You get hundreds of millions. We probably don't need to get the boomers, right? And I would say, yeah, just look towards the future. Like, we have 10-year-old kids and younger already 3D modeling in Roblox and building something, right? Like, but what I do think the jobs, and this especially with generative AI, everyone's like really just like worried, like, okay, what jobs are going to exist? What's going to happen? I still think of generative AI like these are all just tools, and hopefully it just powers everyone. Lets everyone create. And I think that's the fundamental interesting thing about the opportunity in the metaverse is to allow, like, I think it was you mentioned more players becoming creators, right? And allowing people to benefit. Like right now, we think about how many people have made 3D games, 3D worlds. It's pretty hard, but like with generative AI, with VR, AR tools, it's going to become much more easier. And I think what we're also going to see is this kind of like, it's a shift in the creator economy. Like right now, I would say the internet sucks, not because Facebook's evil or Meta is evil necessarily, but because Meta relies on advertising as their main model to make money. And so because of that, they have to do a lot of clickbait garbage, promote clickbait garbage, hate speech. They have to also do invasion of privacy to better target those ads. But what's nice about something like in Roblox, where people are selling digital items to other people directly, not mediated through advertising, then it's a much better, it doesn't promote that toxic behavior. So if we can keep that as the fundamental business model of the metaverse, I think we'll be in a much better shape than what we have with the internet today.
Yeah, I would say we're just not building for the boomers, like those older generations. I always joke, like, my parents would have grown up with like the advent of like the consumer internet. My grandparents had a wired landline until they were 90. Like they did not, that was not a value for them, but that didn't make the internet any less valuable to all of us. And then we grew up with different technologies, like having the smartphone in our pocket, and my dad had a BlackBerry. Until recently. Like, that's just like, it's just how it is. And I think we're always building for those next generations that grow up with the new technology. It becomes widely adopted. You'll always get your adopters in the older generations, but that's not who we're building for here. Or, Roblox isn't successful because it built for, me as a, late 20-year-old. It was built because it was a great area for kids to hang out and experience things together and play together. And on the job side, I think actually the bigger unlock is going to be being able to expand your customer base as in, for whatever your IRL job is. You'll obviously have, your metaverse builders. I think Second Life's a great reflection of these markets and stuff where people were making tens or hundreds of thousands of dollars just 3D modeling for other people so they could purchase those assets. But you'll have everything from like, health tech moving into it to, people in industrials and oil and gas and all these areas that can, I think, be more accessible to more people. And I think that I don't know how many like new jobs we're going to get. I think it's going to be more about expanding the market for specific jobs and being able to access more customers from wherever you are.
So actually, like, I'm gonna reply in a different vision, like in a different point of view. Like, why Metaverse is that much being invested is not just for fun or for the consumers, but there's also like, as much as you move, as much as you take something from somewhere to somewhere, like you have your carbon footprint. And there is a very huge problem in the world at the moment is about like the climate change and etc. And now, in the industrial processes, it's crucial to have the metaverse technologies in the process of like either the production or the other processes of the factories and all the environments. Like, for example, Microsoft just started some, not just, but in a couple of months, started a partnership with Mercedes-Benz. So they are now building electrical cars in fully metaverse technology, like, which is called digital twins. Probably most of you have heard about it. Like, digital twins are going to replace human being, like, in all the processes of production, but they have to, because maybe it's going to be a bit crucial to say this, but we have to choose environment through a generation. This is why we can't be nervous, like we can't feel anything about like the baby boomers or the older generations, but we have to go for the environment because we have tons of generations coming up in the coming years. So we need that, like, I don't know, we need that technology to really build on the digital twins and whatever needed in order to keep the environment safe much more. This is why I think on the job base, like, this is why the kids at the moment are learning to do coding when they are 4 years old, 5 years old. It's crazy, but this is the reason, because in the past, maybe our fathers and mothers, like, they were learning being, I don't know, like being an economist or like being an engineer or whatever, but now the kids are learning being a coder, or like, I think there are going to be new jobs such as like ChatGPT writer or like a questioner or something. Like, this is going to change. People are not going to be unemployed maybe, but the next generations, we don't have to worry about them. And the old generations, we shouldn't be worried about them as much as we worry about the environment. So this.
I don't know if I have anything to add, really.
No, that's okay.
Take the next question. I think just the market forces will force the change, regardless of whether you want to or not. Like, AI and the development of AI already shows that. When the market forces will be strong enough for VR, AR, or metaverse technologies, it's going to happen whether you want it or not. And we need people like my girls want to be vets and barbershop keepers. So I've tried to get them to coding school, but it's not always successful either.
Yeah, I think the whole topic around
every job is important.
Right, and coding we know is something that is just one small piece of the whole industry. Yes.
So when you guys are looking at a prospective investment, what are the 3 things that excite you the most when you're evaluating something?
So definitely, like, the application of this technology, especially like within the VR AR, like why is this hopefully a driving application that's going to prove that this needs to be adopted, this technology? Because there's still a lot of friction, a lot of barrier to entry in terms of like either getting this new technology adopted in a company or getting even a consumer to put on the headset. Like, this has to be better than Zelda, right? Like, that's hard. But the other thing, honestly, is team. Like, why are these the right people to do it? And then the last one, is this a venture scale opportunity? Can this be a billion-dollar company, not a quick flip, or, can they do 100 million in revenue eventually, right? And understanding that opportunity. Those are like kind of the 3 main vectors that I look at.
And yeah, just to start with the team side, I think one of the most important aspects of vetting an opportunity is why you want to build this. I think some people or some founders look at this as like, it's fun, it's a cool technology to build for, but I think the most valuable businesses are built by people that are solving a problem or a need that they had, and they've clearly seen the issues in the market, and they want to build for a future where those problems aren't there anymore. And so that is something I generally look for is just that why, and it's usually very clear. If it's just I just see a big opportunity here, I mean, that's fantastic. I mean, that's completely fine with me. But I like knowing that you want to solve a problem that you've had already, and then. I personally love technologies that almost don't have competitors because the technology doesn't really, I think, make sense at this stage. And I do like when people are building for something that they think is coming in the future. And I think that's where a lot of value comes from. I mean, a lot of times it's so easy to just say, yeah, we're going to build a better product than company X. But the issue is that, that product's already out there. There are people leveraging it, and I think you can create value that way, but I kind of like when people are trying to create their own markets. And I think that is one of the more exciting opportunities, kind of watching those markets form themselves and seeing value come out of these areas that other people weren't looking for. And I think, it always goes back to like this Josh Wolf quote of like, we want people to agree with us just later. And I think that is a really interesting way to look at building a business. It doesn't need to work today, but building for a future where it does work is where I think a lot of value is going to be created.
And I would say scalability, because like this is a virtual world, and anything that you could imagine could be done one day, but it's important if it can be done today, or like it needs a bit more technology, or it needs a bit more time to be able to do that. So idea and the team is really important, but for me at least the key one is the scalability.
It's repetition, but it's team. Number one team, number two team, number three team, almost, especially if it's pre-revenue. One thing that I'd say you should kind of forget is don't fall in love with the technology, because that's what we've seen so much in VR and AR is, like Taylor said, the why, you're solving for a problem, you're not solving because you're doing it in VR or AR. So it's a technology that is used to solve a problem, regardless of the platform.
And one thing I would add is just don't change your business just to, I think, raise money. Or like if investors disagree, that we don't know everything. And I think that's a mistake some founders make, is like, I need to create a business that is going to give me the best opportunity to raise money. And I think it's more of finding the investors that are willing to fund that type of project instead. And I mean, if you're building something you don't care about and just need to raise money, it's generally not going to become successful.
100%. Yes.
Matthew Hightower, I'm a co-founder at Lemur AI. So kind of a two-part question, but I'll keep it tight. So one has to do with outreach to investors like yourselves. Are you guys still reading emails with pitch decks and getting back to people, or is there like a barrier to entry to getting a meeting where we have to go through portfolio companies and work through them to get a meeting? So one, are you guys still kind of answering emails or LinkedIn messages with pitch decks? And second is, if you guys like what we do and set up a meeting and everything goes well, what are some of the like due diligence, documents or things that you look for that, you hope startups have prepared already?
I would start, well, one, you can always cold outreach, but I will say there's just so much more value in a warm intro, whether that is going through a portfolio company or other investors. I mean, if an investor passes on you, you always should be asking, like, is there somebody else you think this might be interesting to? But yes, I mean, we get cold outreach all the time. We respond to the LinkedIn messages. We respond to emails. I mean, that's where the majority of deal flow is going to come from for almost all investors. Whether or not it's where they make the majority of their investments is a different story. But I think trying to find that to a fund is extremely important. And also, really, if you're going to cold outreach, I think it needs to be more than just, hey, this is my company, here's my deck. This is why I think we would be a good partner for you all, or we would be a good investment for you all, and why you all as investors would be a good partner for us. And I think making that clear up front is extremely beneficial. It always shows a little bit of extra work, and I don't think it takes that much time to look at someone's portfolio or look at the backgrounds of the investors in that firm. And then on the data room side, it really depends on your stage, but I think everything from for me, the most important thing is again, why the team is important. Being very clear about that. Product roadmaps are also extremely important, and product timelines are also extremely important to understand. Like, if we're going to fund this company for the next 18 to 24 months, what are we expecting as investors to get from that capital being invested? And I'll personally say, even we've invested in companies that we passed on their pre-seed, did their seed round, and usually it's because I go back and look at that pre-seed deck and I say, all right, here's what you pitched me on 18 months ago. Let's see where you're at today, and either you've accomplished that or exceeded those expectations, and that is always extremely helpful, because just because somebody passes once doesn't mean they're gonna always pass again. But at your stage, I mean, just it's very basic. It's obviously having the entire founder backgrounds, obviously having product roadmaps, use of funds is always extremely important, and I think it's pretty basic. I wouldn't really overthink it. And I think at like a pre-seed seed stage, sometimes the data room is even a little overkill. Like I don't really need like incorporation documents and stuff, which I think is a lot of what happens a lot of times. I open up, it's just a bunch of legal documents. But I think just having a very clear deck, and I think your deck that never really needs to be more than 10 pages anyways, so kind of shows how much information you really need to show at the earlier stages.
Yeah, I think you said it very well. I mean, the only other things I'd add to is just, make progress. Get out there, either, again, if you're like a gaming company, go viral with some pre-release stuff. If you're an enterprise company, have some really interesting pilot programs with some customers. I mean, that gets people noticing you, and they'll come to you if you're making really good progress, right? Like, I think that's a big part that's underestimated, or that people are, oh no, I just need to go. It's like, do what you can also to make yourself known and to make yourself valuable, that we'd want to approach you as well.
And very quick thing to add, please ask for the feedback when you get rejected by either an VC or an angel investor. Please ask for the feedback, because we are always like willing to give feedbacks. It could help for the future, asks that you are gonna make.
Yeah, I do want to add, customer and market feedback is extremely compelling at the early stages. Even if it's just, this is an industry expert just giving their opinion on this product, that's always great. And if you have any referrals, that's always helpful as well.
Maybe just to close, like, we try to answer all cold emails, all LinkedIn DMs, like every channel, but the volume of deal flow for everyone is probably massive. So if you dig around a little bit, you will probably find one connection or one connection off from your next connection who knows the investor. So while you probably need to have a bit more patience for cold outreach, if somebody else kind of pokes the VC and says, hey, look at this, it always will make it easier to open up that dialogue. And it has to be a dialogue. So it doesn't, like, for us, we like it when it's not just transactional, like, hey, we're sending you our deck, we're raising, but instead try to build those relationships like very early on before you're at the stage where you're fundraising.
Questions from the back. We haven't had that much chance to take any questions. Anyone? All right. Well, I have a question, and that is about boot camps, accelerators. Is there advice that you'd have for founders when they are considering that landscape, because it's vast? There are so many of them. What are the things that you look for in terms of those being aligned with the founders, and some tips on evaluating those?
I mean, not just for boot camps and accelerators, but for any investor, whether it's an angel or a VC. I mean, talk to their portfolio companies, talk to other companies that they've invested in, and find out, like, are they a right fit for you? Do they add value, or are they just, whatever? And, talk to a couple, because, everyone has a different experience. Your mileage may vary, but I think it's worth understanding, like, has there been success? I don't want to, name call anyone, but like, there was a incubator that recently kind of imploded, and the horror stories that come out of it are just like insane. But I think a lot of people too, it's like, they think, all incubators aren't incubator. Okay, it's a class of things. No, there's no like regulation on who gets to call themselves an incubator, really, I think. And so people just do all sorts of different things. So definitely know them by talking to the other companies they've invested in, both a successful one and especially one that's failed.
Yeah, I mean, there was a question about DD, but you should definitely DD your investors as well. I mean, it's a long-term relationship you're entering into with your investor. So definitely talk to the portfolio companies, ask for referrals also. If the investor's ego doesn't take it, it's probably not the right investor for you.
Yeah, and an accelerator versus an incubator are two very, very different categories. But on the accelerator side, I think it actually is important to, I think, have more of a name brand accelerator behind you. Those networks are something that you can't knock. They're so strong. They have the greatest advisors. I think they are extremely valuable. But you just need to go into it understanding that, I mean, this is not a funding round for you. This is a hopeful path to a funding round. And it's still your company, and you really need to pick the accelerator correctly based on, I think, vetting the ones that have done well, vetting the companies that have not done well, figuring out if that is a accelerator problem or just a company problem. And on the incubator side, I mean, that's it. I don't know how helpful it's going to be because that's more of, you're building somebody else's idea, basically. I don't think it's very helpful for many founders to look for an incubator program since it's just not going to have aligned values.
And I would go and do the due diligence with the graduates of the accelerator program, like the previous program graduates. Maybe ask them how the program really supported you after you graduated, because like you can always get trainings and education or like any support from, like you can even get it from the internet. So you have to get something after it when you graduate. Are they really leaving you in the ocean, or are they really supporting you after you graduate as well? So it's important to be part of a network rather than just getting the training.
100%. Does anyone have any more questions? Oh, sure.
Hey, thanks so much. I'm sorry if this question is a bit naive, but would you be able to talk about effective valuation at the pre-seed stage and estimating financial need? Just your general thoughts on it. I don't know so much about it.
Yeah, when it comes to pre-seed, I think it's almost just a math equation. It's how much funding do I actually need to accomplish my goals to get to that seed round, and then kind of backing into a valuation that's going to probably be within anywhere from 20 to 30% dilution. So if it's I need $1 million, probably around a 5-post company at the pre-seed stage, assuming general pre-seed traction, which is usually minimal, but. It really is just kind of figuring out what that number is, and you can always back into evaluation. And I think at those earlier stages, you're going to probably find yourself anywhere between like 3 to 6 posts, just depending on the capital you're looking to raise.
Thank you.
I have time for one more question. Okay, he's waving very exuberantly.
This is a quick one. By a show of hands, who in the room is raising funding? And by a show of hands, is there anyone who's not on stage who's actually giving funding? Nobody. Okay, good to know.
There's some people back there. I saw it. Well, let's all give Tipatat and Taylor and Cansu and Petri a big round of applause.